as long as China has a trade deficit with the U.S., and let's face it, it's China surplus, U.S. trade deficit. That's really what's going on here. Other countries are a little bit caught in that confusion. China will need to invest in U.S. dollar. It can't just invest all of its surplus in gold for that cycling to happen. So on the margin, it's important. Certainly, it makes sense from China's perspective if it sees the United States as an unreliable partner to invest in gold. The two reasons I think gold is rising are just one, all the volatility. So whenever there's volatility, you move towards gold. But secondly, central banks like China and particularly Russia have invested a lot in gold recently.
Let's go downstream a bit to look at the impact on earnings and margins for US companies and therefore, by default, the US market. I guess when it comes down to it, like everything in life, it depends. It depends on what kind of company you are. Depends on whether or not you import raw materials. What are you seeing and how do you invest?
I think that Rick's comment that the market's partying like it's 1999, we have to remember that party didn't end very well. So we want to be a little cautious on that. We're positive on the market outlook as a whole. We don't think we're in 1999. We're in a situation where the market, and especially those higher priced technology companies, have earnings. So they justify their very high valuations in a way that companies did not justify their valuations in 1999. Specifically to your question about tariffs, it's very hard to, given what we were conversating before about, we don't know what tariffs, what level they're going to be or anything else. We don't know where they're going to come. It's very hard to judge companies based on that. But in general, tariffs aren't as simple as increasing the cost for foreign finished goods. As I'm sure you've reported many times on the show, there's the intermediate goods in terms of what it takes to manufacture. So even goods that we might think are manufactured within the United States would have parts that come from overseas. Our big theme in the market this year is that we see a market that's going to broaden, that's going to go beyond the Magnificent Seven. So I like to say I'm quite positive on the S&P 493 or smaller cap stocks. If you look at some of those stocks, especially when you go down the cap level, you can find stocks that are much more domestic than you would find by definition in the large cap stocks that tend to be more global. So we're positive on the equity market, but moving down, broadening out.
Stephen, just real quickly, back to this whole idea of broadening in the market, getting away from just the tip of the spear, the Mag 7, right? So the other 493, which goes into small and mid caps as well, right? One, on tariffs, they're probably better insulated, so that's good news. What about, what do you think the drivers are going to be for this broadening and for small and mid caps? Is it going to come more from, say, tax cuts? Is it going to come more from deregulation and M&A or what?
It's all three of those. So we've had a real shortage on M&A. So I think that regulatory change, that's one of the big positives. By the way, that's a positive for private equity and private assets as well. Less regulation. Regulation hits smaller companies more than larger companies. Larger companies, there's an argument that larger companies like regulation because it's an impediment to competition for smaller companies. So deregulating should help smaller companies. And those smaller companies often, as you mentioned or I mentioned, are more domestic oriented and so often are less dependent on foreign services. It's interesting I say that word services. Tariffs are at this point mostly on goods, not on services. So in general, services companies won't be impacted as much as goods as manufacturers.